Okay, and we are live. Hello, everyone, and welcome to the second episode of the Big Whales Market Call. My name is Aleksandar. I'm a research analyst at the Big Whale, your host, and I write research on the Bitcoin and convergence between traditional finance and the digital asset realm. This is a monthly format, so each month we host the sharpest minds in the digital asset industry. Joining me today are André Dragosch, head of research at Bitwise Europe, one of the biggest ETF and ETP providers, and certainly the first one to launch a new ETP product on the market from Frankfurt. Theodore Chapman from Madrid, if I'm not mistaken, Theo. He is institutional partnership at Babylon Labs, the greatest or the largest Bitcoin staking protocol with 7.1 billion in TVL and more than 57,000 Bitcoin deposit to their protocol. If I butcher the numbers, please correct me, but that's the last print that I read. And my dear colleague Raphaël Bloch, co-founder and editor-in-chief of the Big Whale, that is joining us live from London, as well as me, not Serbia this time, but London. Okay, gentlemen, welcome to the show. I wanna remind the audience that you can submit your questions in the comment section. 10 minutes at the end, at the minimum, will be dedicated towards answering them. So now a quick word about the Big Whale. We are an independent, fully B2B and leading digital asset research platform in Europe. Of course, if you want to learn more, visit our website that got a new touch and fresh look. So shout out to our tech team for pulling that off. The agenda for today's episode is packed with alpha as it was in the first one. First, we'll dig into Bitwise's latest report, Rate Cuts in an Inflationary World, Bitcoin and Return of Financial Repression, to dissect the implications of accelerating inflation, global growth, and other macroeconomic indicators impacting assets in our portfolios across the board. Then we will hear from Theo about Babylon's approach in maximizing Bitcoin yield and helping institutions to offset inflation and debasement. And finally, we will explore the probability of alt season lasting longer in Q4, or should we expect final rotation back into Bitcoin for the end of the year? Before we get started, I want to thank our sponsor, Bitwise. Now, let's dive in. So last time we spoke, it was September 10th. It was a week before the Fed interest rate decision. So we were discussing about the all near 100% probability of a Fed rate cut, and also markets were euphoric back then, anticipating the rate cut. And the evidence for that is a huge amount of leverage long trades open on various different platforms that inevitably led to one of the largest leverage flushes, aka liquidation events, arguably this cycle. But yet the quality of these assets retain the capital flows, maintain demand levels, and recover pretty quickly. So, André, in your report, you argue that the Fed's new rate cutting cycle, combined with the rising inflation expectations and expanding global liquidity, forms a medium-term bullish macro backdrop for Bitcoin. Could you elaborate on that and explain all the elements aforementioned for us here?
Yes, of course. Yeah. Thank you so much, Alexander, and thank you so much for the invitation again. So very warm welcome from my side as well. My name is André Dragosch. I'm European Head of Research at Bitwise. Maybe just a couple of sentences about Bitwise. So Bitwise itself is one of the largest crypto specialists, right? We are one of the largest crypto asset managers globally with around 15 billion US dollars in client assets and around 120 colleagues that are working from both North America and Europe. And I'm based in Frankfurt. I'm working for Bitwise Europe. And we have, I think, around 30 plus products already based on Bitcoin, but also on other digital assets like Ethereum and Solana and so on. Yeah, so much about Bitwise. To your question, I think, as you mentioned, the title of our latest report is Rate Cuts in an Inflationary World and the Return of Financial Repression, right? Because as you mentioned, the Fed has cut rates as expected in September, right? Was expected with 100% probability, right? But now, as the chart on the left-hand side shows, the market still expects further rate cuts. The market still prices in around 3 rate cuts until year end, right? Based on Fed funds futures. So, and I think it's totally consistent with what the Fed is telegraphing, right? The Fed is telegraphing based on the dot plot on the summary of economic projections, around 3 rate cuts this year, right? And I think around 4 rate cuts next year, right? But it doesn't happen in an environment where inflation is decelerating, right? It's
Yeah.
happening in an environment where inflation is picking up, right? It's accelerating. Of course, the Fed has essentially pivoted from weighing inflation metrics too heavily, right, towards overweighting employment metrics, which have been deteriorating, right? The labor market has been deteriorating in the US, and the forward-looking indicators like conference board survey and so on, consumer surveys, they actually imply that the labor market will continue to deteriorate. So from that point of view, it makes sense for them to continue cutting rates. But yeah, it happens in a macro environment with accelerating inflation. What does it essentially mean if like rates are going down and inflation is going up? It means real yields will come down, right?
Yeah.
And the reason why it's bullish, that's the perfect chart for this. So it's a bit more complicated, but let's start with the one on the left-hand side. So you have to know that real yields itself, they are the single best indicator for the stance of monetary policy. So let's say you have to choose between like hundreds and thousands of macro indicators, and you have to say you have to tell whether monetary policy is easy or is tight. Just take a look at real yields, right? The level itself is not so important, right? The absolute level. The delta is more important, right? And on the left-hand side, you can see the green line, which is monetary policy pricing, which is essentially policy as priced by financial markets, all kinds of assets, equity markets, bond markets, FX, commodities, and so on, against the change in real yields, which is inverted, right? So real yields going down means, okay, it's going up. And you can see there's such a strong correlation between those two. So the fact that real yields are going down is very bullish because it implies an easing in monetary policy as priced by all financial markets, essentially. And it's also associated with financial conditions in general, right? Which is shown on the right-hand side. Easing monetary policy, Fed rate cuts, and so on will lead to looser financial conditions. And we know it's very bullish for Bitcoin because Bitcoin tends to trade inversely to these financial conditions. So Bitcoin tends to thrive in an environment where financial conditions are loose, right? And vice versa. It tends to suffer or underperform in an environment where financial conditions are tightening, right? So that's definitely bullish.
I want to touch more on that. So basically, we have seen that 10-year yields all over the world are exploding, except maybe in US. So we have Japan 10-year yield hitting all-time high. I think the same could be said for UK and France. My question for you is that, do you see maybe Fed, because the inflation is accelerating and real yields are the spread is reducing constantly, do you see that maybe Fed are they going to hit like a pause button? And if they do, God forbid, but if they do, what implications would that have on assets in our bags? So primarily risk on in Bitcoin.
So if you look at these two charts, they're actually quite perfect to explain this. So you've mentioned that the long end of the curve, like whether US or Japan, UK, Germany, right, has been moving up, right, has been moving higher, despite rate cuts. Most of the time, even since the Fed cut rates, the long end, the US 10-year Treasury yield has been moving up, right, despite rate cuts. And because of various reasons, because of rising inflation expectations, because of rising term premia, and so on. But what it essentially does, it has steepened the yield curve, right? And you've seen this kind of yield curve steepening, not only in the US, you've seen it in Japan, you've seen it in the UK, you've seen it in Germany, almost maybe except in China, right? That's the only exception. But across the globe, you've seen the steepening in the yield curve. And why is this so important? Because the moment the Fed cuts rates, it steepens even more. That's like the historical pattern, right? You've seen the increase in the long end, but the moment you see rate cuts, tends to steepen even more. And the key to understand in this context is it's highly correlated with liquidity growth. So the moment you see is this kind of steepening in the yield curve, it implies an acceleration in liquidity growth, right? Which is on the left-hand side. So M1 money supply growth tends to be highly correlated to steepness of the yield curve. So that's very bullish. Because if you believe in this relationship between Bitcoin and global money supply, right, on the right-hand side, right? Some people say it's spurious, but we think there's at least a long-term relationship between global money supply and Bitcoin. So if you believe this to be true, and money supply will accelerate because of this steepening in all these regions, right? UK, Japan, US, and so on, then it actually implies that the bull run will continue, right? So that's definitely bullish.
One more vertical that's actually following the path of growth in M2 is stablecoin supply.
Mm-hmm.
So, Raf, you do extensive research, you do extensive coverage of the stablecoins. How important do you see stablecoins contributing to the rise in global liquidity? Because we all know that stablecoins are a liquidity layer of crypto, but in broader term, how important do you see the mass adoption in stablecoin tied to the increase in money supply and global liquidity?
Yeah, sure. No, it's a really good question. So as you know, I was in Frankfurt for Sibos last week, and yeah, of course, stablecoins are one of the, or maybe the biggest topic of the moment with Bitcoin. And the interesting thing is that it's not anymore a B2C topic. It's getting more traction with banks and financial institutions. And so if those financial institutions like, big banks, Société Générale, BNP Paribas, Santander, Deutsche Bank, or JP Morgan want to put more money in stable coins, it will be, a massive inflow, and we will see a massive inflow on stable coins. We went from 150 billions of, market cap 1 year ago to, we just crossed 300 billions. And yeah, the interesting thing is that the new forecasts are more around 1 trillion in the coming 24 months. And as you know, stablecoins is like the getaway, not only for payment, but also for investment. And yeah, we can imagine that those inflows will not stay in fiat, but maybe will go also in the crypto market. I think that this thesis is quite interesting. So on one hand, a part of the stable coins will attract fiat on bonds, but after all, this is the biggest challenge for us, is to assess how much of this money will go through, especially Bitcoin. So yeah, it's not that big for the moment, but yeah, for the next 24 months, we will see a massive inflow in stablecoins, and after all, in the crypto markets.
Yeah. Thank you, Raf, for the answer. Obviously, it's undoubtedly true that stablecoin has in very high significance for markets and especially digital asset markets overall, as they present the liquidity layer. Now, I want to touch more on cross-asset performance for the Q3. So one thing that's been boggling my mind is this graph right here. So basically, gold really won the year so far in performance with 47.04%, which is that fact alone still boggles my mind. And also, when we compare the cross-asset performance month to date, gold beat both Bitcoin, equities market, and Ethereum, of course. Maybe not for a quarter, but for month to date, certainly it did. So, André, please shed some light on this. Why is gold outperforming risk on assets?
That's probably the question of questions. But so I think it's definitely quite remarkable that both these hard assets, right, gold and Bitcoin, have been one of the best performing assets alongside Ethereum, right? So crypto assets, the major crypto assets, and gold have been the best performing assets. And it's usually called the debasement trade, because I think what investors are realizing is nothing stops this train, as Lynn Alden says. So I think there's the realization that the US government will have to manufacture some kind of environment of higher growth, but also higher inflation to get the fiscal debt problem under control, right? And that has led to this kind of rally in gold, and plus government shutdown, geopolitical risks, and so on. But I think that's the key investment narrative. And in order to understand why gold has been outperforming Bitcoin, I think I've prepared an interesting chart in the macro section on the macro factor model that we calculate. This one exactly. So in order to understand this kind of performance difference between these two hard assets is based on macro. Both assets, both Bitcoin and gold, are macro assets. You can explain most of the performance variation with 4 major macro factors, which is global growth, monetary policy expectations, US dollar and Eurozone breakup risks, right? And the rest is coin specific, industry specific. And on the if we look at the one for Bitcoin on the left hand side, you can see the greenish area is very large, and the greenish area is global growth expectations. And it shows like the majority of Bitcoin's performance over the past 6 months has been dominated by global growth expectations, right?
Okay.
Which is very different from gold. On the right-hand side, you can see for gold, it's been mostly monetary policy expectations and the US dollar, not so much global growth expectations, right? So essentially gold has already started to price in this easy money era, right? This new macro environment with Fed rate cuts, growing liquidity, and so on. Bitcoin has actually been lagging because it was more geared towards global growth expectations. But our expectation is that these global growth, the global growth outlook will actually improve going forward because monetary policy tends to lead global growth, right? Monetary policy tends to lead global growth. Right, and therefore, over the next 6 to 12 months, you should see some kind of catch up from Bitcoin to gold because global growth expectations will continue to be very positive, will most likely continue to surprise to the upside. Right, no recession. We don't think there will be a recession in the US because liquidity growth is rampant, right? It's so strong. Yeah, I think that can explain this kind of difference between those assets.
And just André on this, what is the timeline? And thank you very much because it's really interesting to see this. This difference between gold and Bitcoin. What's your expectations and the timeline to see maybe the same pattern for Bitcoin as gold? Like a non-correlated macro assets.
So what we are generally also observing is if you look at the relative performance ratio between Bitcoin and gold, it is like a risk on risk off performance ratio, right? Risk on risk off indicator. And it fluctuates, it actually cycles with global risk appetite. So the moment you have like a risk on environment, Bitcoin tends to outperform gold, and if you have a risk-off environment, Bitcoin tends to underperform gold, right? And so what we are already seeing is Bitcoin has massively underperformed gold on a historical basis over the past 90 days, right? Over the past 3 months. So we think this kind of underperforms long in the tooth, right? And going forward, we should see a leadership of Bitcoin over gold again in terms of performance. Not that gold's underperforming, right? It might consolidate, move sideways, but we think it's an even higher because the debasing trade's still ongoing, right? But we think Bitcoin will reassert its like leadership in terms of performance and outperform gold as we move into this risk-on environment, right? With like higher global growth expectations because of this monetary policy easing and so on.
In terms of price prediction?
So our official target's still 200K by the end of this year. It's still quite ambitious, but Q4 tends to be the best quarter by far, right? And based on various models, Bitcoin right now is like a coiled spring. And we think there's so much catch up for Bitcoin right now based on global money supply growth, based on scarcity and so on. We see so many actually bullish indicators. I think I've included the chart on exchange balances and a liquid supply in the Onchain section as well. This trend actually is continuing, right? I mean, exchange balances on the left-hand side, they tend to get revised very often, so they're not so reliable. But the trend is quite clear, right? It's going down, which means supply on exchanges is going down, which tends to be bullish for Bitcoin, right? So there tends to be an inverse relationship. On the right-hand side, you can also see a different alternative metric, which is liquid and highly liquid supply. It doesn't have to do anything with on exchange balances. It's derived on a proprietary methodology by Glassnode, But it's the same kind of message. Liquid supply, highly liquid supply is going down. We just had a brief hiccup in the summer during July, August. Exchange balances ticked up. There was increasing selling pressure, increasing inflows to exchanges. But since then, like the downtrend has continued. And so we think this bullish thesis of like a demand overhang / supply deficit on exchanges is still intact, right? And the reason is, if you go back to the previous slide, the reason is there's such a strong imbalance between demand and supply, right? If you just look at new supply, which is like the new mine supply by miners, Bitcoin miners, which is like the black bar on the right-hand side, it's around 120,000 Bitcoins this year that's been mined. If you plot this against institutional demands by global ETPs, Bitcoin ETPs, and corporate treasuries, it's like being outsized by a factor of 7 times, 8 times, right? It's
Massive,
even stronger,
massive.
a massive demand. And
Massive
you can
demand,
see on the left-hand side, essentially since the launch of the Bitcoin ETPs, institutional holdings, so the percentage share of institutional holdings in total supply has been moving like from bottom left to upper right corner, right? It's
almost as if it's exponential curve.
Yes, doesn't seem to stop. It only pauses. There's some kind. Sometimes it tends to pause, right? During the trade policy shock, right, in early this year, right? But still, it tends to go up, and I think this is causing this kind of excessive supply decline. Right?
Shock, yeah. Okay. Thank you, André, so much for the explanation. Gold may have outperformed Bitcoin in Q3 and month to date. However, Bitcoin maybe has one, let's say, a secret weapon embedded in the tech stack built around Bitcoin staking. So I want to ask Theo, Theo, how does Babylon help transform Bitcoin from idle store of value to productive store of value?
Yeah, thanks, Aleksandar, for the question, and thanks, the whole Big Well team for having me on today, and pleasure to be speaking with André as well and the Bitwise guys. Currently, if you're to look at Bitcoin from a non-Babylon perspective, currently there's around $2 trillion worth of Bitcoin just sitting in cold custody, which is around 99% of all Bitcoin, or over 99%. And at Babylon, our mission is to enable that Bitcoin to be used as trustless and productive collateral without ever leaving the Bitcoin network. So the problem with Bitcoin maybe being an idle asset and not a productive asset is that idle assets tend to lose value over time, and we're trying to change that by making Bitcoin trustless while remaining on the Bitcoin network. And so until today, before the Babylon protocols were around, if you wanted utility on chain with that Bitcoin, you'd have to go through custodial wrappers such as CBBTC or WBTC, which introduce a sort of counterparty risk, which is the opposite of Bitcoin's main ethos, which is don't trust, verify. And so we believe in these trustless use cases with no wrapping, no bridging. Regarding how we're turning Bitcoin from an idle asset or an idle store of value into productive store of value is via our staking protocols so far to date, and via new protocols which we're building post the staking protocol. And today you can see the demand's already there for productive use cases on Bitcoin. It's not just theory. The Babylon Bitcoin staking protocol, we've amassed about $7 billion worth of Bitcoin, about 57,000 Bitcoin, which is currently staked. So I think it's the fastest adoption of any non-custodial technology in an institutional sense seen in the crypto space so far to date. So yeah, we're seeing many more productive use cases emerge, and Babylon's one of them. We view Babylon Bitcoin staking as kind of the benchmark for Bitcoin DeFi.
Okay. Thanks for the answer. So basically last time in September, we had Joseph Shalom. He's CEO of SharpLink, and he argued and explained to us that one of the advantages in establishing Ethereum digital asset treasury is on-chain yield for Ethereum. So they can kind of create a cash flow out of staking Ethereum on-chain. So my question for you is, do you see Babylon as a trick up one sleeve for Bitcoin digital asset treasuries in creating a similar effect as Ethereum digital asset treasuries already doing with on-chain yield?
Yeah, I think the short answer is that the the appreciation of holding an asset comes from the spot price, right? Bitcoin itself is the inflation hedge and the thing that creates outperformance and the hurdle rate. And if you look at the average CAGRs of Bitcoin over the last 10, 15 years, it's always been around sort of average 40 to 50%. And going forward, under the Saylor model, we're going to continue to beat inflation over the next 21 years, assuming that Bitcoin maybe has a slightly lower CAGR of, say, between 20 and 30%. So I think what Babylon does, is kind of adds on to that CAGR with an additive yield or kind of return rate, which is trust minimized and trusted. So it's a benchmark style return. And I think, it's another kind of asset to a Bitcoin treasury company's wheelhouse if they can offer different products like this. Obviously, it's not going to fit every Bitcoin treasury company. It depends on their mandate and the kind of strategy they're outlaying. But I think you can, if you were to break it down, you can look at, think about this in kind of three layers of return, like the spot Bitcoin exposure, the native on-chain Bitcoin products, using Bitcoin as this kind of collateral via Babylon staking, or this new protocol that we're developing called Bitcoin Trust as Vaults. And then you can also layer on, optional leverage, like running derivative strategies off-chain on top of the Bitcoin held in custody. So yeah, I think, regarding how Bitcoin treasury companies could use it, I think we're still very early. I think the market still thinks we're very early, hence, given the kind of 80% drawback we've had since the May to June to July highs of those treasury companies. And I think, the Bitcoin treasury companies could start with a pilot, depending on their kind of risk and governance cycle, measure the Bitcoin per Bitcoin accretion that any Babylon protocols bring to the strategy, and the added Bitcoin per share over time, because that's the sort of ultimate KPI for Bitcoin treasury companies.
To that point, how would you, Michael Saylor explicitly stated that he wouldn't do anything with his Bitcoin. So he wouldn't lend it out. He wouldn't, create a cash flow out of it, or create kind of income stream from his holdings. So my question for you is, can Bitcoin Trusted Vaults that you implemented at Babylon be a game changer? And how would you convince a kind of decision maker at Bitcoin Digital Asset Treasury to change his mind on deploying Bitcoin as a productive capital? And how would you, explain the counterparty risk that's involved in a transaction?
Yeah, I think it's super interesting. So Babylon Bitcoin Trust as Vaults is a new protocol that we released in August. We released the white paper, and essentially we're allowing Babylon to be used as trust as collateral for the first use case might be borrowing against the Bitcoin via on-chain rails, so cheaper cost of credit, and kind of different from how people have borrowed against Bitcoin traditionally with CFI credit facilities, which generally lead to higher interest rates and kind of fixed term loans. So yeah, the benefit to that point, the benefit of using this product or this protocol that we're developing is that there's actually, you don't touch the Bitcoin. And, I like the Saylor quote that Bitcoin is money, everything else is credit. So if you can issue credit based off the Bitcoin as the collateral asset, then I think it's very powerful for these treasury companies, especially in situations, where they might be trading below NAV, for example, at a discount to the NAV, and therefore issuing additional equity could be dilutive to the shareholders rather than accretive, issuing equity, above the net asset value on the balance sheet. So, following on from that, Bitcoin Trust as Vaults, Bitcoin holders can pledge Bitcoin on the Bitcoin L and borrow USD stablecoins without the kind of custodial wrappers or the bridges. So you could fund operations and dividends while keeping that Bitcoin exposure on the Bitcoin L1. So that could lead to funding coupons with preferred equities, CapEx, and just giving you like working capital in fiat, so you don't have to sell the Bitcoin. And I think, the result of this is, as I mentioned earlier, cheaper programmatic credit, which gives utilization-driven rates in the DeFi sense, which are also open term. So there's no kind of fixed term like in TradFi, like 90 days, 180 days, 360 days for you to repay the loans of that. and auditable risk. It's all on chain. You can look at the oracles, the LTVs in real time, and not have any discretionary kind of liquidations. So essentially, you can finance fiat obligations without equity dilution or that custodial wrapping, which I've spoken about with WBTC. And then also if you're to think about maybe doing some mini maths on this, for example, say you have 1,000 Bitcoin, and that Bitcoin is priced at 100K. That's $100 million, which you can use as collateral. And a conservative LTV, loan to value ratio, would be around 30%. So let's say you then take a loan against that 100 million of 30 million, so 30%. And the borrow APR typically in DeFi right now against Bitcoin assets is about 4 to 5%. So you get 4 to 5% loan, which is variable and open term. And then you can use those proceeds technically as a treasury company to fund, let's say 10% preferred coupons for 12 months while keeping your Bitcoin exposure intact. So I think it's super interesting from that angle. And you're seeing other like treasury companies like Nakamoto, which is a spin-off of the Bitcoin magazine. You're seeing them actually take out. Sorry, yeah.
Yeah, no. Thank you very much. Just one question. How do you explain, the success of Babylon? It's because the market is still immature. I mean, it's quite hard to just lend and borrow Bitcoin. I mean, how will Babylon look like in, I don't know, 4 or 5 years with a more mature market, especially for credit on Bitcoin?
Yeah, I think it just becomes more the standard more than anything. I think on-chain is the future we're heading towards. And I think that having a kind of gold standard trustless protocol with billions of dollars locked up in these different protocols as the sort of track record, I think that's going to be the way things evolve in the future. And digital is inherently a sort of winner takes all phenomenon. And I think, there'll be a couple of protocols on top of Bitcoin that can be the trustless infrastructure or the trustless rails for kind of the next generation of financial on-chain products on Bitcoin.
And just a follow-up question on this. Are you see more traction from crypto institutions and maybe more traditional institutions rather than whales and wealthy investors?
So we're engaging. I mean, my role at Babylon is institutional partnerships and strategic initiatives. So we're engaging all types of institutions, from ETF issuers to miners to custodians, funds, family offices. And I think that generally speaking, in terms of capital allocators, it can be broken down into 3 buckets, right? There's self-directed retail, there's financial advisors, and then there's institutional capital. And the breakdown of that is like 20% self-directed retail, 40% financial advisors, and 40% institutional capital, like pensions and endowments. And so far, the crypto bucket or the crypto industry has been entirely driven off that first bucket of capital, the self-directed retail. So I think, now we're starting to see institutions come into the space, and I think we're only scratching the surface of institutions coming into the space. There's going to be a big unlock, and, my job is essentially to educate and to kind of build relationships with those institutions that are looking to allocate and to generate the closest thing to a benchmark rate on top of Bitcoin.
Thank you for your answer. It's a very interesting. It's as I said, it's a kind of a revolutionary tech stack in a way to transform Bitcoin's idleness into productiveness. So because we are approaching the mark and we soon start a Q&A question, I will ask you one more question. So to all of you. So basically, we have seen a massive profit-taking event in Bitcoin in Q3, especially in July. So, and kind of Ethereum taking over the show in July, and also the rest of altcoins. My question for you is, let's start with you, Andre. Do you see the final rotation for the 2025 happening back into Bitcoin, or maybe alts have a room to once again outperform the king by the year's end?
So I think, as you mentioned, it's totally correct. You've seen 2 consecutive months of ETH underperformance after strong outperformance, right? Question is whether you see a reversal again, right? I think it's quite likely, because if it's true that we're moving towards an environment, a new kind of risk on environment, right, where Bitcoin is outperforming gold, I think it's quite likely that you'll see that major altcoins, I'm not talking about like secondary altcoins, but like major altcoins like Ethereum or Solana can outperform Bitcoin, right? Because especially Ethereum, it tends to be the relative performance between Ethereum and Bitcoin tends to be a kind of risk on, risk off sentiment gauge as well, right? Ethereum tends to do well also in an environment where there's increasing risk appetite and so on. And so if you think that we're moving towards this kind of scenario, right, with like monetary policy easing, investors moving out the risk curve, risk appetites rising, risk on, right, then I think it's quite likely that you'll see an outperformance of alts, major alts.
Thank you for your answer, Andre. Theo, what's your stance on that?
Yeah, I'd agree with Andre. I think in terms of altcoins, it's going to become more similar to sort of stock picking, rather than in previous cycles where everything just goes up regardless of any real sort of token value, kind of flywheel into that token. So I think, yeah, we'll see an alt cycle, but I also think that Bitcoin's going to have a very strong quarter in coming few months, especially regarding, I think there'll be a resurgence in terms of the Bitcoin treasury companies, which will be interesting to watch. So levered Bitcoin plays, I think, could outperform Bitcoin and then also altcoins as well.
I agree also with the last point, because I think, I don't know who made this observation on Twitter, but there's actually a funny correlation between Bitcoin and gold, right? We talked about Bitcoin and gold extensively, but also Bitcoin and gold and MSTR, right? Strategy.
Yep.
So if you believe like, okay, Bitcoin's outperforming gold, it's actually consistent with Bitcoin treasury companies outperforming again, right?
Raph, what's your opinion going into Q4?
Yes. No, I agree with the guys. I would say, of course, Bitcoin, and I would add that I think everything except fiat will take off. So every risky asset, will also take off. So not only, gold, but of course, Bitcoin. And I think that in the stock market and also tokenized stocks will be interesting to follow up. But yeah, definitely quite, bullish on the tokenized stocks, Bitcoin, and more bearish on fiat.
Yeah. Okay, thank you, gentlemen, for your thoughtful answers. I enjoyed the discussion quite a bit, and I hope our audience did too, and they learned something. So we are now going to proceed to Q&A section. So the first question is from Lauren. So at each 4-year cycle, we have bullish signals on the macro, yet the drawdowns happen. Have you reassessed the pre-drawdown periods of previous cycles to understand what caused them? Pure Bitcoin factors, more macro factors perhaps? And do you see a risk of cycle drawdown in 2020? I think, André, it's a perfect question for you.
I think, so our general view, just to talk about expectations, our general view is that the 4-year cycle is dead, right? 4-year cycle in terms of the halving cycle. But that being said, I think there's an interesting coincidence between US business cycles and halving cycles, Bitcoin halving cycles, because coincidentally, in the years where there was a halving cycle in the past, like 2012, 2016, 2020, you also had US business cycle troughs in the ISM manufacturing index, right? So it's totally conceivable to say that previous Bitcoin cycles, like bull and bear cycles, were not created by the halving itself, but by the business cycle, global business cycle, US business cycle, right? And I think what actually supports this view is we had a bear market in 2022, which was like, we had a very strong bear market in 2022, and which was also associated with a strong tightening of monetary policy and a business cycle drawdown, right?
Yeah.
And I think, but moving forward, I think because the halving is becoming less important in terms of like supply deficit, because if you look at the annualized supply deficit induced by the halving, it's only around 164,000 Bitcoins per year. And you've seen the institutional demand bar chart. Institutional demand is almost 1 million Bitcoins this year, right? It's outsizing the halving effect already. So I think we're moving away from a supply-induced kind of cycle, right, towards a demand-induced cycle for Bitcoin, bull bear cycle. And that ultimately means macro will become even more important, right? The business cycle will become even more important. The monetary policy cycle will become even more important. And we know Fed's cutting rates, other central banks are cutting rates, liquidity is going up. So we think that we won't see the cycle top this year because of the halving pattern. We think that we will see a prolonged cycle well into 2026.
And a perfect follow-up question from Gao Feng is at which quarter in 2026 you guys think that bull market will end? Will it end? Yeah.
Very good question. I'm not sure. It could very well be that we'll see the cycle being extended until 2027 as well, right? I mean, but I think the base case is that this bull market will continue at least until next year. That's at least our base case.
Yep. I mean, just to follow up on this, I fully agree with and I think that the more corporate we see and institutions we see in this market, the less it will be volatile. And of course, we know that retail is not the same investors as institutions. I mean, it's a long-term investment when you are a fund or a bank instead of retail who just, will follow the path, the trend, and maybe will just buy and sell quickly. So yeah, I agree with you on the fact that it could be also more driven by the macro and the US trend, and also the fact that as soon as you have more institutions, we will see less effective four cycle impact.
And you talked about Luxembourg, right? Acquiring Bitcoins like the sovereign wealth fund. I mean, we haven't even seen like big sovereign buyers. Maybe Abu Dhabi, the sovereign wealth fund, Mubdala, right? But we haven't really seen like central banks starting to buy Bitcoin on a large scale, right? I think that could even prolong the cycle even more, right? We haven't seen 401ks invest yet, right? At least not the self-directed 401ks have probably invested already, but like on an institutional scale, we haven't seen this large flood of capital yet, right?
Theo, what's your opinion on 4-year cycles? Is it going to end in 2026, the bull market?
I would trend towards the opinion that the Bitcoin winter as we know it is over, but we might still see a drawdown from, let's say, 500k in a bullish sense to 300k or something like that. I don't think we're going to see winters in the same sense that we have done, and I think institutional buying will remain consistent and keep up. And as you say, they have a long-term perspective on assets, so that's very positive for Bitcoin.
Okay, and the final question for today, and also a $1 million question from Patrick, is: can Bitcoin be really considered as gold, since the number of retail investors remains very low and does not change a lot year over year? It seems like it's always the new investors, old investors, recycling the capital. André, what's your opinion on that?
I don't know whether it's connected. I mean, to the first question, is it better than gold? I think yes, right? We know it's absolutely capped, right? 21 million. We don't know the max cap of gold, right? It has a relatively lower supply growth rate, around 0.8% versus around 1.5% for gold, right? So it's scarcer than gold. It's also higher in terms, it's better in terms of transferability, verifiability, divisibility, and so on. So it's technologically superior. That being said, of course, if you from a very big picture view, right? So if you look at the world pre 1971, post 1971, and let's say post 2022, is so pre-1971 you had the gold standard, right? Bretton Woods Agreement. Post-1971 you had a fiat standard based on US Treasury bonds, right? So US Treasury bonds are still the de facto reserve asset, right? The world has been moving away from gold towards US Treasury bonds. Now it's moving back to gold, right? Away from US Treasury bonds, essentially since 2022 when the West froze Russian assets, right? So since then, you've seen like this remigration of capital away from US Treasury bonds, like the new reserve asset, de facto reserve asset, to this old reserve asset again, gold. And it makes sense because people were used to gold. There was a gold standard pre-1971. Makes total sense. That's probably why we've seen this outperformance in gold and not so much in Bitcoin. But I'd say that Bitcoin is even a better hedge than gold against US Treasury bonds. It's less correlated to US Treasury bonds. It has even better downside characteristics than gold. Gold tends to be more interest rate sensitive and tends to be more correlated to US Treasury bonds. So I think moving forward, if you see an increase in US Treasury bond risk and sovereign risk overall, I think more capital will migrate towards Bitcoin because it has better diversification properties than gold. Yeah, I think both assets are profiting from the fact that US Treasuries are losing their appeal, US Treasury bonds.
Yeah.
So it's not so much like Bitcoin versus gold right now. It's rather Bitcoin and gold on the one end, right? Against US Treasury bonds and like fiat assets on the other end, right? That's happening right now. I mean, we can see it in the performance. But I think like over time, let's say over the next 10 years, you'll also see investors repatriating capital from gold into Bitcoin.
Yeah. And that explains why gold is so sensitive to the erosion in Dixie, because, you know, the people are shorting US Treasury bonds and longing gold as a monetary hedge. But the role of Bitcoin as a deflation hedge, or as a monetary hedge, it seems like that we are going to see how its role develops over time, and how, as the market matures, of course, it will be clear to us. So thank you once again, gentlemen, for this discussion. I really enjoyed it, and thank you all the guys for amazing questions. So this will be it for October's episode. I'm looking forward to November's one. And yeah, thanks once again to the Bitwise for sponsoring this video. You can also follow us on social media, and that will be it. So gentlemen, once again, thank you for participating, and see you next time. Bye-bye.
Thanks. See you next time.
Thanks.
Bye.
Bye.
Great day. Bye.